Good morning, everyone. Welcome to the Finance Committee and the third review of our budget later in the program. So my opening remarks are going to be very limited, but importantly, I want to commend again our KICA staff for their efforts in general and in particular around the budget. It's a big lift and there are lots of moving parts. And so I appreciate Dale and his colleagues pulling this together. The second thing, if there are non-finance committee members on the line, I would just remind everyone that we are looking for candidates for the Finance Committee. I think the deadline for applying is the end of this week. So if you are out there in Radio Land and are interested in serving on the Finance Committee, please go to our website. The application is digital and apply. And then finally, we will, after pursuant to this meeting and the conclusions from this meeting, there will be a special budget, hey John, a special budget review with the board in early November, and then the budget will be submitted to the board for approval on November 10th at a public board meeting. So Dale, I think I will turn it over to you. And I think the schedule of events for today is a review of investment performance with our friends and neighbors at Morgan Stanley, and then the third quarter financials, and then the latest iteration of the budget.
That would be correct.
Okay.
Good morning, Michael and Dave. Thanks for joining. Dana, I'll just go ahead and turn it over to you. Thank you for being here and getting together with the Q3 report.
Wonderful. It's good to see you all. I'm going to just double check to make sure you can see my screen.
We can now.
Okay, wonderful. Well, Stuart and I can be fairly brief, but we always welcome and love your questions. We did, for this quarter's report, we continue to solicit your feedback, and we really appreciate the input you provide. We have provided a new kind of summary portfolio performance table at the top of our executive summary. The font is small, so we will work on that and work on formatting next quarter. The other thing to note is that as there was a request to break down the returns by equity, fixed income, and cash. As we look at the cash dollar investment gains in here, you don't have negative investment gains on your cash. That's just where the fees, the management fees for the portfolio and the manager fees are pulled out of. So we'll probably adjust that next quarter just to show not applicable because it's not a meaningful number. However, I think it's a really nice summary just to see all in one spot. How have each of the kind of three buckets of money that we're managing for you, how are they allocated? What have the returns been on a quarterly, year-to-date, and since inception basis? And when you look at the since inception columns off to the right, just note that these are annualized figures. So the good news is for the reserve fund, the MRR bucket, the portfolio has generated north of a 9% annual return since we've been partnering with you. Now, that has largely been driven, and this is a theme you'll see across all time periods, that has largely been driven by the 40% equity exposure that you have within the portfolio. As we know, equity markets, while they've been volatile, continue to be, quite frankly, on a tear. And that has really benefited the MRR, the reserve fund returns. When you look at the most recent quarter, and we've got commentary on this below, first of all, we're right on your targeted asset allocation within the portfolio. 40% equity, 60% fixed income, not making any major tactical moves one way or another. Within the latest quarter, the portfolio returned north of 4%. And that again was driven by strong returns across fixed income and equity. But when you break down the returns, you can see that the 7% plus returns across your equity portion of the portfolio were the major driver of the 4% return. As we scroll down, we provide some additional commentary on how your portfolio has performed versus our stated investment policy statement. So take a step back. If we remember the reserve fund, our goal is essentially to outpace out inflation. And we have a chart in the back of this report that shows, the construction inflation rate sits around 5%. It's around the figure that you used in your 2026 reserve study as well. So our goal with the reserve fund is to outpace that 5% figure. Since inception, 9.3% return net of fees. So we are outpacing that figure. When you look at shorter time periods, we are underperforming the IPS benchmark. On the quarter, it was about 20 basis points. A couple of comments on where we're underperforming the benchmark. First of all, the benchmark is just indexes, so there's no fees, right? You're never going to, the benchmarks themselves don't have fees embedded in the returns. And then secondarily, over the latest quarter, we've had some minor underperformance. And that was driven by underperformance across your emerging market equity manager within the portfolio that has a 2 to 3% allocation. So small allocation. It's a manager that over time has done well over longer periods of time, but in the shorter periods has underperformed. When we look down to the operating fund and the designated cash fund. So the operating fund, our mandate with you is to manage in a very secure, short-term fashion, less than 12 months. And then the designated cash fund has a slightly longer time horizon, up to 24 months. And you can see since inception, you've generated between 4 and 4.5% returns on these two portfolios. And that's really in line with what we'd expect given where rates are. And, the slightly longer duration we've been able to take on the designated cash fund, you've earned about 20 extra basis points within that portfolio. So I'll pause there. I know Stuart was going to go over a couple of market metrics that really help explain, I think, some of the underlying portfolio performance details. But before we jump there, I wanted to see if there were any initial questions or feedback on reporting.
So I had an observation. So you referenced the long-term producer price index for construction materials. It's actually on page 79 of the deck. And I find it to be a very useful schematic. And you see the 10-year rolling average there, which, as you mentioned, is hovering right around 5%. And so for the committee, this is just an observation, and it's an observation I've made before. And so I'm not looking for, quote unquote, an answer. But I'd like the finance committee to think about whether there is an inherent conflict or not conflict, inconsistency between our target portfolio mix of, let's say, 40% equity, 60% fixed income on the one hand, and on the other hand, to hedge our inflation costs on the other. So if the long-term rolling average of construction inflation is around 5%, how much equity do we need to predictably stay ahead of that long-term rate of inflation? So it's something that we're not gonna resolve today, but it's something that I think we should consider, because to me, there seems like there might be a inherent inconsistency there.
Hey, Dana,
I'm sorry. So Paul, your point is that you would want to reduce equity exposure such that on a long-term basis, the delta between this inflation are so we would reduce our equity exposure to make less and theoretically reduce our risk exposure such that we would only perform at the 5%.
So, yes, the short answer is yes. I
So
would
that doesn't
say
make a ton of sense to me, but I understand your point.
I would say it slightly differently. This is not our money, it's our members' money. And if they want to invest in equities, that's fine. But our job is to protect the value of the reserve fund so that we can replace bridges and roads and the sandcastle and so on and so forth. And so to me, that is the number one goal, is to protect the corpus, not to maximize the return. And so it's obviously it's a mix of analysis and judgment. And again, I don't want to sidetrack the meeting today. We've got a lot to cover, but it is something that I think the committee should consider, because the goal is an inflation hedge. That's the goal. Okay, let's
Hey, I had a quick question. Thanks. Dana, are you guys changing your asset? I mean, obviously we've had a terrific run up in equities this year. It's been pretty amazing, even for those of us that work in fixed income. But are you guys thinking about changing that asset allocation to equities?
You mean within the underlying equity exposure, the mix?
Well, actually, more of like I know we gave you guys like a range of equity and fixed income exposure that you can have. And I'm just curious with like how well equities have done. Are you going to reduce or thinking about reducing the equity allocation from where it is today? The overall allocation, not like the mix of equities.
Yeah, it's a great question, Stuart. Feel free to chime in. Right now, we're actually pretty neutral compared to the 60-40 or 40-60 targets within the portfolio. So we
Yeah.
do have leeway. I think it's 5% on each side where we can. And within the quarter, you'll see some shifts, right? It's not always sitting right there. Within some of the sub asset allocations, Bran, within equities is where sometimes we'll make shifts one way or another within the quarter where we have viewpoints.
I
Okay.
think I would just
I see.
add that if we have reticence on increasing the fixed income allocation relative to the equity allocation, I think it's been driven, Brand, primarily by the fact that, not that we're stuck, that's overstating it, but in some respects, with credit spreads continuing to come in, finding areas of opportunity on the fixed income side have been somewhat more challenging as well. So amidst this backdrop of equities doing exceedingly well and then credit spreads continuing to come in, I think where we'd be looking to potentially de-risk is less so in terms of the overall equity fixed split, but within equity itself, maybe trimming back a little bit of the growth equity exposure, having a little bit more of a defensive posture within our equity portfolio. So more within like large cap value, those areas of the market. I mean, we were considering having more of a bias towards small cap securities, but then small caps ran 12, 13, 14% in Q3 alone. So we keep a pretty neutral weighting there. And then international markets, which have been an area that have been relatively undervalued versus domestic markets. And I think international markets this year alone are up 26% year to date. So it's been like good problems, right? I think the challenge in terms of like dialing back some of the equity exposure is not a lot of opportunities to deploy it elsewhere, given just the risk on environment that we've seen over the first 3 quarters. So I would say on the margin, thinking about moving more from growth to value, maybe some of the government positioning within fixed income, given that rates have gone up generally across the board, despite what happened in calendar Q3, but not loading up on corporates right now just because of how spreads have come in here over the last handful of quarters.
Okay. That makes sense. Thanks.
I was gonna
So
add one thing. Oh, sorry. Sorry, go
No,
ahead.
no, go ahead. Go ahead. Go ahead.
I was just gonna reference back to your question. Recall, and we do this usually once a year. And we could revisit. We don't have the document. We didn't send it out in advance of today's meeting. I think we covered it maybe a little bit at last meeting. Yeah, I think Dana's bringing it up now. Recall when we updated our most recent capital market assumptions for the portfolio. And again, we do this once a year. That exercise is completed around the May-June time period. We updated the forward-looking expected returns of the portfolio, given your current IPS weightings of 40% to equity and 60% to fixed income. In the last 2 calendar years, when we've run this study, the return estimates have come back with the same forward-looking expectations. So right around 6% or so, 6.1%, using the current targets that we have in place. And recall when we reviewed this back in the summer, we also looked at what that mix could look like if we were to flex up or down in equity, not by a huge amount, just by 10%, just to provide frame of reference around what could a 50-50 portfolio earn from our perspective versus what a 30-70 portfolio could earn from our perspective. I offer that up just as you all continue to think about the overall level of risk that we're deploying or that we're exhibiting within the portfolio. We can continue to run these analyses and focus on them, and include metrics as it relates to different measures of downside risk, those kinds of things, just to give you all more information as it relates to what we think this portfolio is going to do over the next 5, 10, 15 years to inform discussions around the overall equity fixed split. So just offer that up, that we have that capability, and we'll continue to work with you all on it.
Okay, so Stuart, that would be extremely helpful to help us get our heads around. And this is not a one-time thing. This is something that we should be doing all the time, and we do implicitly do all the time. But if you could help us think about the mix, you know, given the markets, given our objectives, and so on and so forth, that would be very helpful. And I should say, so to be very clear, and this is a point that Bran and others have made consistently, fixed income is not without risk. Let's be clear. If we run into a stagnation scenario, which is, I think, the worst case outcome for us, which is to say our portfolio, you know, our equity portfolio is going to get crushed, and our debt portfolio is going to get crushed too. So anyway, this is a topic that the Finance Committee should spend some quality time on. And if our colleagues from Morgan Stanley could help us triangulate around that issue, that would be very helpful.
Could I make a point?
I know you could.
Can I?
You certainly may.
Thank you. I will. I mean, I just do not, I've said it once before and I'll say it again, sound like a broken record. Why don't we have tips?
I think we have some tips, actually.
Do we? Because given our mandate to protect against inflation, now I know inflation for us is different to the retail inflation, but given the mandate, why don't we have tips? I still don't get it. I'd like our advisors to actually, you know, explain to me why we don't. Not at this time, but another time.
Okay. Well, let's. We again, I don't mean it's a legitimate question, Larry, but I do think it's sort of a tactical issue. We've got a lot to cover today.
Sure, no.
Okay. So there are a couple of other points that I would like Morgan Stanley to focus on for us. Number one, we have additional information relative to the Sage portfolio. And I would like our advisors to take just a minute to talk us through a large part of our fixed income portfolio, which is $15 million, is invested in mortgage-backed securities and other securitized products. So that is on page something. Didn't have it marked.
38, yeah.
So maybe just, so on page 45, you will note that we have total market value of $5.1 million in mortgage-related securities. And then on page 43, we have total market value of $4 million in what we refer to as, sorry. Hang on. So, okay, so, oh, sorry.
Corporate
Yeah,
debt.
so on page 40, sorry, we have $1 million in CMBS. So just take a minute and talk about what the underlying assets are in CMBS and in mortgage-backed securities, just so that everybody is clear about what the underlying value is that support these securities.
Yeah, of course. So I'll answer both those, and then because we're here on the fixed income side, I can quickly address the tips question as well. So within the mortgage portfolio, let's take first the CMBS just because it's highlighted here. Obviously, commercial mortgage-backed securities have been in the news. Real estate, generally speaking, has underperformed, particularly on the equity side, to a lesser extent on the fixed income side. I would say that within this portfolio, as you can imagine, just like any fixed income instrument, there is a range of different types of commercial mortgage-backed securities that we could invest in. That range all the way from AAA in quality all the way to essentially already in default or near to default types of obligations. Within this portfolio, it's essentially a AAA portfolio of very high quality commercial mortgage-backed securities. There's very little risk being taken in this portion of the portfolio, understanding that it does have real estate exposure. These are AAA rated, very high quality office industrial portfolios or baskets of loans. So it's just meant to provide diversification within the portfolio itself relative to the other types of instruments that we're holding. I wouldn't say it's it's not used as a alpha generator per se, more of a diversification tool within the portfolio. There's decent yield that's being provided off of these securities, but again, very high quality rated, not a lot of risk being taken in this portion of the portfolio relative to, and I guess risk is relative, right? Like we don't allow high yield within this portfolio, like full stop, at time of purchase. So it's not as if we're investing, down into junk bond territory within this portfolio, but even within our portfolio, this is some of the highest quality instruments and CUSIPs that we're investing in.
Stuart, maybe what would also be helpful is just to like explain that mortgages are like a huge part of the benchmark that you're compared to. So maybe just a little color on our weight in or Sage's weight in these instruments versus the benchmark weight. And mortgages are like the second largest fixed income sector after treasuries in this benchmark and as a whole per se. So, but anyways, I think maybe giving that color would be helpful for the team as well.
Yeah, and I would say, and we can get the exact stats, they're not listed here. I would say that we have a slight overweight to mortgages in aggregate relative to the benchmark. Brand, to your point, it is a significant component of the investable universe here in the US, particularly once you exclude like high yield or other instruments that we just wouldn't invest in within this portfolio. It makes up a significant portion of the overall investable universe. We are slightly overweight to mortgages, actually, particularly on the residential side. The rationale for that is if we're thinking about, well, could we just own a basket of government bonds? Or do we want to have some areas of the portfolio that offer additional spread or additional income beyond just owning government bonds? Within this portfolio, primarily our choices are investment grade corporate bonds or mortgages. As I referenced earlier, in investment grade corporate bonds, we've seen continued compression in spreads, narrowing of spreads. That's been good for the total return of the portfolio. Mortgages haven't seen as much spread compression, so they trade at a relative advantage from our perspective, from a valuation point of view, relative to having a significant overweight, as an example, to corporate fixed income. Now we have, 26% of the fixed income portfolio within corporate bonds, so we still like investment grade corporate issuers. We still have a good amount of exposure there. But from a relative valuation perspective, we find a little bit more value in very high rated mortgage instruments, either on the commercial side or on the residential side. And I would view that as, maybe defensive is not the right word, but just acknowledging that with respect to corporate spreads, we've seen aggressive narrowing in those spreads here over the last handful of years. So from a valuation standpoint, find a little bit more value in mortgages than we do in corporate bonds. But again, striking that balance between seeing that relative value, but then also making sure that we're focusing on AA, AAA rated securities.
Stuart, what is the underlying for the $300,000 of market value in asset-backed? Are those credit cards? What is the underlying?
Yeah, it's two securities. We can go back to Sage. I don't know off the top of my head, Paul. We can go back to Sage. It's either credit cards or auto loans. So they're both AAA rated. Those are the two biggest like areas of issuance within asset-backed securities would be credit cards and auto loans. So we'll go back again, both AAA rated tranches of those pools, but I'll get confirmation, can follow up with this group.
The first one is clearly Amex.
Yeah.
So, yeah.
I'm pretty sure they're credit card.
I think they're both credit card. Yeah, okay. I see the Amex is there. Yeah, I'm not sure what the second one is. We can confirm.
Okay, and then the bigger piece, which is the mortgages, the $5 million. So these are all Fannie and Freddie securities?
Yes.
Okay.
Just
And to
circling back
Brand-
on the ABS, the comment is Capital One credit card receivables,
Okay.
and the first one is Amex. Yeah, so they're both credit card receivables, which is really an ABS, like the higher quality portion of the market. You don't necessarily want to be in like subprime autos. Well, we don't want to be in that anyways. So, but yeah, they're both credit card receivables.
And there's actually been some disruption in that market of late. Is that right, Brian? I think
The
in
subprime or the
subprime
credit card? Oh yeah.
in
Subprime.
subprime auto. Yeah.
Oh
Yeah.
yeah. There has been, yeah.
Yeah.
There's definitely some winners and losers in there, but yeah, there's been the delinquencies have really picked up, unfortunately, in that space. So, but credit cards are pretty boring, quite frankly, but relatively safe.
And I think to Brand's point earlier, just to give some context, I know we are slightly overweight mortgages, but mortgages are in the high 20% of the underlying Bloomberg aggregate bond index. So they do make up a large part of the index as well.
Yeah. And just to be clear, I am not uncomfortable with those securities. I think they fit with, I'm quite sure they fit within our investment standards. But I do want everyone, especially on the finance committee, to understand that these are composite securities with underlying instruments that we're never going to have visibility into.
Yeah, like the one thing I really would, for next go around, I think it would be helpful for the committee that we have what the index weight is. Like, in the US ag, mortgages are like 24.4%. So us having 30%, it's, I don't know what the duration on that is, but like it's it's pretty decent overweight. I'm personally not critiquing it or any way. I mean, like, great. Mortgages have really outperformed lately. So great call. But like, I think it would be helpful just so people understand within here, like what our overweights are. For next go around. Thank you.
Yeah.
Absolutely. We'll bring that back next quarter.
Thanks.
The only other point that I wanted to observe, or issue that I wanted to bring to folks' attention, is on page 13. And page 13, I think, is a good chart in that it looks at the quote unquote expensiveness, that's a word, of the equity valuations. I think it's not a surprise that the market feels a little toppy. So I guess I'd like to ask the Morgan Stanley guys, you know, at what point do you institutionally feel that equities are overbought?
Yeah, I think it gets back to Brand's question earlier too, where we acknowledge that, particularly within large cap stocks in the US, mainly large cap growth oriented companies in tech, communication services, there's been a significant rally, and it's driven the overall valuations within the market to, well, you can see it here. It's certainly relatively high by any historical measure. We could pick other measures of earnings, and the chart would look pretty consistent. I think our thoughts as it relates to this continue to be focus on high quality managers that on the active side provide historically have provided downside protection. So within the active managers that we have within the US portfolio, generally speaking, they've done a really good job protecting in down markets. Some of them have struggled to fully keep up in up markets. Now we have index exposure within the portfolio, but the two ways that we're thinking about this chart in particular are with our active managers, really focusing on ones that have a quality bias, even if that means we don't get 100% of the upside when markets are doing well, knowing that we have some index exposure within the portfolio, such that if we do have a sell-off, we have managers in place that have historically done well. Second, as I referenced earlier, on the margin, but I don't want to overstate it because we're not going to swing this portfolio back and forth between like value and growth. It's thinking more about more defensive equities in the large cap space and moving some of the portfolio there. Areas that have underperformed here in the last handful of quarters, think of sectors like staples or healthcare, less in terms of cyclicality or cyclicals within the portfolio itself, but areas within the US equity market, again, focus more on large cap that haven't performed quite as well. Those are the two areas where where we can de-risk, are de-risking, knowing that small cap has done really well, particularly over the last 6 months. And then international equities, again, up 26% year to date, an area that would be an easy place to overweight, but just the returns in that market here over the first 9 months of the year have made it more difficult to reduce risk within the US portfolio, given the run-up that we've seen there too.
What else do you have for the group, Dana, Stuart?
You know, this is your time. We can go through more market update and answer any questions. I think we got some good feedback, bringing more information on our fixed income exposures versus benchmark, talking about tips and some of the sub asset classes within fixed income. So we will certainly bring that back. We continue to welcome any feedback you have on the reporting. We want this to be useful to you, but I guess in general, the overall portfolio performance, we're very pleased with. So,
any other comments, questions from the group? Awesome. Thank you, Dana.
Thanks a lot,
Stuart.
guys.
Really
thank
appreciate
you for your
it.
time.
Cheers. Thank you all.
Good morning.
Bye.
Moving on.
Okay,
So Q3 quarterly financial report. all the forecast data is pretty much the same as what we've already talked about throughout the budget process. So my intent is not to really delve into this in any level of detail. But as always, I always welcome questions and comments. I would like to touch base on page 5, and let me bring this up.
Cash management status?
So just to point out, the operating, checking, and sweep, typically I like to keep those numbers a little bit lower. But because of recent maturities in the investment under 12-month and impending payables and upcoming payroll, that was a little higher at the end of the quarter. Oh, thought I did. Also, in the past year or so, I've kept a bit more of the dollars in money market funds just because their rates were really competitive compared to treasuries. But as those rates change in the future, I would look to manage that a little bit more towards the treasuries if those rates are more competitive. And then manage the maturities so that I can fund our operating expenditures. And as it stands, we have sufficient resources to take care of the rest of the year's activities with an ending anticipated balance, which you'll see on in our budget work here after this meeting. You'll see that kind of ties in with our ending unrestricted cash. Also on page 18, as it pertains to the employee benefits, and this is just an update for the group. In August, a subgroup with financial and health benefits expertise was formed to help guide our health benefits renewal for 2026 and actually beyond. The subgroup includes staff, 2 members each from the Human Resources Committee and the Finance Committee, as well as USI, who is KICA's agent. Because we were self-insured over the last 21 months, we've gained a lot of claims data, which we never had before because we were fully insured under group size of 100. KICA's aggregate loss ratio for this last 21 months consistently exceeds 100%. And actually for 2024, it was 122%. Which, whether we were in a self-insured platform or fully insured, significant increases would be expected, right? If fully insured is experiencing those losses, they're going to increase our costs as well. We've had several high-cost claimants that cause us to exceed specific, which is the individual stop loss and aggregate stop loss. Although in 2020, 2024, and 25, those excessive costs were borne by the reinsurance, the stop loss insurer. But again, as I was stating, it causes us to have significant renewal quotes. And it also, in this self-insurance platform, gives us the possibility for lasers, which are basically higher specific stop loss thresholds. So instead of the 45,000 or 46,000 that we currently have per individual, that could go to $50,000 or $55,000 or higher. And then because of all this, yeah.
I was just going to ask a question. So I don't want to interrupt your flow, but is this the right course of action to take? Is there any question if we shouldn't be self-insuring?
Well, I'll get there.
Okay. All right. As I said, I don't want to break your flow. Sorry. Apologies.
Wait for the climax.
You're a mind reader.
I mean, just looking at our new forecast for the year, it looks pretty disastrous in terms of we've gone up from a Q2 forecast of 1.7 million employee benefits to 1.96.
I'll explain that too.
Yeah. It's above the budget as well.
Yeah.
We totally
So-
burst your setup here. Apologies.
Yeah, you're no worries. I'm just trying to catch you up, to be honest with you, because we haven't had a lot of conversation in this regard. So I'm just trying to catch everybody up. So in order to give KICA the best opportunity to mitigate these costs and the risk for 2026, and then obviously beyond that as well, the subgroup is recommending to the board in a meeting this afternoon that we move to, you ready, Bran? A fully insured program for 2026. And for reference, we've added $200,000 to the 2025 forecast. So that's speaking to Larry's comment. And that represents terminal liability or the stop loss premium for,
Okay, now I understand.
Okay.
For the tail.
for the tail. And it also includes the projected run out claims, meaning what we call IBNR, which is incurred but not reported. So
So
incurred in
it's a catch-up.
2025, but not reported till 2026. So that's an additional 200,000 that I've reflected in the new budget when we get to it.
Okay.
Okay. And I've reflected it in the forecast. Okay. With that being said, the 2026 forecasted costs for fully insured program, they're $300,000 less. So we've gotten a really good quote from United. We do have some administrative costs for that run out tail of 12,000. So the net in 2026 is 288,000. So overall for this switch, it would be an estimated $88,000 to the benefit, right?
Okay.
And it's not a real, there's some burden on the employees with regard to the changeover to a fully insured going to United. But we've got a ton of support and on the admin side and education for the staff. So we're comfortable with that.
And the finance committee representatives are comfortable, you know, two people.
Yeah. So the subgroup is recommending this to the board, and the board's going to meet this afternoon to actually discuss and we think approve that switch, which because we have to notify the various carriers and so forth very quickly. So that's why it's being done outside of the November 10th budget approval process.
And I would just add that because I was able to sit in on one of these sessions with our insurance broker, that while we're making this recommended shift to a single provider coverage, the fact that we were self-insured for a year means that we learned a lot and we got a lot of data and analytics relative to our employee base that will be helpful to us in terms of planning our coverage for the future.
So we were always real concerned that we were getting these 25% increases from the fully insured carriers, not knowing our claims history, right? Obviously, it has to be directly related to that, but we had no details to it. So now we do.
So is our claims history worse? Sorry, I don't want to overtake this meeting, but is our claims history bad? You know,
Yes.
as against,
Well,
if you benchmark us against,
Thanks, Dave.
against the town of Kiowa, for example.
so we're 122% of cost ratio too. So we're way over our premiums paid, right? So yeah, I'd say we're way higher than expected. And it's primarily because call it 3 or 4 high cost claimants.
So Larry, we have a small pool, right? The number of insured lives is less than 100, fewer than 100. So if you have 2 or 3
Sure,
people who
I
have
understand
real
that.
issues, your claims results are going to be worse.
But
And
how do we benchmark against the town of Kiowa, for example? You know, they've only got 20, 30 employees. Have you done any?
No idea.
We also couldn't get their claims data.
So rates are set actuarially. So the
Sure.
benchmark that you need to think about is the claim performance versus the premium. So we're 122%. So we're significantly higher than people than our demographics would suggest that we should have, right? So that's the way to that's kind of the way to think about it.
But not
So the
not to
intent
beat
was,
not to beat too much of a dead horse here, but does that mean there's like, but there, assuming there's no fraud, is it the type of work that people are doing that are more prone to be?
Yeah,
Or
if
maybe
you
this
have
is like a way
no,
talk,
some
sorry,
it's not
people
workers'
with
comp.
yeah.
It's not
Go-
workers' comp related. It's health, you know,
Just
whether
like
it's
cancer or something,
surgeries or, yeah,
yeah.
exactly.
Gotcha.
unlucky.
Okay, interesting. Wow. Thanks,
So
guys.
so
Interesting.
so the reason why we keep saying less than 100 is because if you have a plan and you're less than 100 and it's not self-insured, you don't actually see the performance of, you're not allowed to see the claims performance, right?
Exactly.
So
I get it.
we went into the self-insured decision, I guess, skeptical that our claims performance was as bad as it was, and we were just getting these large increases historically, and so the thought must have been, hey, let's go self-insured. We can buy stop loss to prevent us from taking catastrophic dollars, and then we'll learn about what's going on. And then I think what happened is we learned about what's going on, and we have some long-term issues with individuals. I don't know about what they are, and I don't know that any, other than HR perhaps, even though we have the claim information. And so now we're saying, okay, can't expose ourselves to that. Let's move back to being part of a bigger pool, and we'll go to a fully insured a plan where we'll just be part of a bigger pool, but we're gonna pay more. I mean, not
Yeah.
more. We're not. You can't run away from your claims experience over time. And so we're not going to be able to do that.
Part of the
Interesting.
reason for
Thanks.
moving to self-insured too was that we could be more proactive with regard to the costs. You know, we were really active with regard to pharmaceutical rebates, sourcing of pharmaceuticals. USI really helped us with that. Education to employees. So there was intent there to be proactive with regard to costs. And we did as much as we could, but again, because we need flexibility for future renewals, there's part of this too is looking at the options for ICRA, the acronym of which I don't remember, but it's basically setting it up, employees out to the public marketplace, but providing a stipend per se, and then they manage with USI and the administrator the types of coverages they get, the plans they get, so forth and so on. So in order to get to that option, which may be feasible and practical, we needed to go in this direction as well. So the intent of this is not to have any action from the finance committee. It's more to brief you, get you up to speed, and inform you as to what's happening with the board this afternoon. With that, unless there's more comments.
So I just had one thing that I wanted to focus the committee's attention on. So on page 13, and there's nothing new here, but I just want to make sure people understand something and make sure that I understand it correctly. On page 13, we have the Q3 operating cash flow statements, and on page 20 for the operating fund, and on page 23 we have the same schedule but for the reserve fund. Now in the top section you have the sources of cash, and I just want to point out that the last item in the sources of cash, both on page 13 and page 23, are investment interest and realized gains. Now in the operating fund, the unrealized funds are going to be modest, and they're going to be modest because the nature of the investments that Dale makes, that we make in the operating fund, is there's not going to be a lot of volatility there. There's no equity, and there's maximum of 2 years duration on the fixed income investments. However, in the reserve fund is where we have longer term debt instruments, which have their own set of volatility and equity. And as Dale notes here, this is investment interest and realized gains. So realized gains means what, Dale?
As we sell, we realize the appreciation.
Right. So if we have an investment and it's $10 and it goes up to $11 or $12 or $13, those are not realized. Those gains are not realized, and they do not show up here unless we were to sell those securities. So I think what happens, but Dale, correct me if I misstate this, when we do our audit at the end of the year, the auditor looks at the financial statements and the investment returns and so on. And at the end of the year, if my security went from $10 to $12, at the end of the year, after the audit is completed, that $12 becomes a realized gain. Is that correct?
Not if it's still, no, unless
So-
it's sold.
Okay, so it never becomes a realized.
Until it's sold. So
Okay,
for this statement, you remember I used to have a reconciliation to GAAP down below. I removed it just because it adds nothing to this. I continue to do that just because I have to do GAAP for the audit. So that's just is below the line, so to speak, with regard to unrealized gains, right?
okay.
So it doesn't have anything to do with the cash statement, but it does when it comes to
Okay.
GAAP.
That's very helpful. And shame on me for not remembering that schedule, which is good, which is helpful. So just keep in mind that especially as it relates to the reserve fund, you could have a lot of value in terms of realized gains, or the opposite, unrealized losses that would not be reflected there unless securities are actually sold. And that is relevant because at the end of the day, how much, guys, could we just have one conversation at a time, please? That's really important because at the end of the day, for the reserve fund, we want to know how much value there is, whether it's realized or unrealized.
So I can make a comment in the future that just says, as of whatever, we have unrealized gains not reported in this statement.
Can you
of
advise us
X.
now how much it is?
I
please?
think my recollection is like 1.6 million.
For the year?
Yeah.
Sorry, cumulative, sorry,
Cumulative.
yeah.
Something to that effect. Okay,
But that's not reflected in the balance sheet at all.
it's reflected in the balance sheet. I don't do the cash balance sheet. So the balance sheet actually represents those
And it
dollars.
is definitely reflected in the quarterly investment report.
Right.
Well, it has to be, yeah.
Yeah. So moving on to the budget. Okay, and that's this document. Again, we've been through a lot of the detail. My intent with this is to point out some changes and then touch on the key points that leads us to a recommendation to the board.
Yeah.
Could you pass one of those down, Larry?
Printed off some stuff. But not a bunch of-
So changes from last draft result
He wants budget, that's-
primarily from the self-insured to fully insured program. And if you go to page 4, this just gives you a recap of where we started. Cash deficit from the second draft, our prior meeting. For forecast, it's 29,000. For budget, it was 882. The change in forecast, as I mentioned, was the $200,000 additional costs. That gives us a revised cash deficit forecast of 229. If I move up, that's this number right here on our statement, right? On our last draft, that was 29,000 and it just increased by the 200. And likewise on the budget side, 300,000. It's actually 288 net of the 12,000 additional costs, but you see the impact. And then down below, it's ending unrestricted cash and the impact on that. For the forecasts, we reduce our ending unrestricted cash to the 1.2 million. And then obviously there's a cumulative effect of that cash for the ending balance in 2026. So you take the 200,000, but then add the 300, which is actually 288, and you get to the new budgeted ending, which is this 692 for 2026 budget. Any thoughts, questions? So if we go back, commercial access fee rates, we had some discussions with regard to whether we increase those rates or specific rates within the schedule. That's on page 5 and 6. On page 5, you see, this is an ad from last time, commercial access rate, market analysis. See across the top, our first column is Kiowa Island, then you see Seabrook, Wild Dunes, Dunes West, and Sea Pines. And you see that we're the highest in multiple lines, and including large vehicles, and we're on the high side for 2 other line items. I think, Paul, you had indicated that you were pretty firm on having some level of increase in staff's orientation based on these increases in market, the increases over the last several years, which you see on this page. And the market analysis, we were still recommending a flat environment.
Yeah, no, I'm loath to disagree with the judgment of staff, especially on something like this. So my preference was to have seen an increase. There's going to be an increase in assessment, I think. But it's not, you know, a crazy big deal for me.
Okay, any other thoughts, comments?
So it's a 3.3%. Sorry, I was thinking about something
No,
else.
commercial access fees, we would stay flat.
What you
Okay,
see here.
From last
okay,
year.
Because you benchmarked. The last meeting we had, you said you were going to vote away.
No, that was related to assessments,
Assessments, okay.
and we'll get there.
Last meeting, you asked us to benchmark.
Yeah, okay.
So I still agree, keep the commercial rates flat. I think the narrative that goes with this needs to make it clear why, because we did such a fast increase in the prior years, and we expect going forward, these will now move with inflation.
Okay.
I mean,
I
I just
agree.
think there needs to be.
Yeah, I would agree with that. Yep.
Amenities rate schedule, that's on page 7. And again, it's affirming the future year's rates. We didn't talk about those in any detail. 2026 is already set because we've already booked a lot of the events in 2026.
So Dale, has this amenities rate schedule been reviewed by the amenities committee?
Yes, sir.
It has.
Yes, sir.
So any further discussion on that, or? It's basically just affirming that we've looked at these rates and for the budget, and I guess how far out, 2027? What's flexible in this if they were approved by the board? All the way out to 2028 would then be set, or?
I mean, the board could always change 2028. Sorry. The board could always change 2028 or 2027, but it won't impact any contracts that are already let. The issue for event space is we're booked a year, 2 years in advance for weddings, et cetera. So you won't affect any currently signed contracts. You would affect smaller events that are coming in at the last minute.
Okay.
And it looks
Yeah.
like those increases are pretty healthy that are already scheduled, right? They're sort of all in the 10% range.
Yep.
Yes, they were pretty healthy, and the amenities committee went through a whole exercise of looking at both their comparable market, but also a full in-depth look at our cost and in order to set the rates.
Okay.
I would defer to that for sure.
Okay.
Makes sense.
Next item, Preserve and Ocean Park, year-end fund balances. Within the budget, Preserve, we're projected in the 2026 to have 2025. The Preserve is expected to have around a $15,000 ending fund balance, and Ocean Park, $34,000. Because the budget anticipates eliminating the KICA responsibility, the Ocean Park and Preserve specific activities there. KICA would still continue all the common area support and activities. We're looking at needing to do something with those ending fund balances. The goal would be to distribute or disperse those to an existing HOA that would be, I guess, legally able to accept that on behalf of their members. Absent that, then we would propose that we disperse those to the members on record as of a date of disbursement, and that would probably be at sometime after the audit. Absent thoughts, comments? So then the next item, board initiative, designated cash. So I went back and went through our asset listings for those assets for which the asset replacement dollars apply. And we have a little over $3 million in total asset original costs, and the accumulated depreciation, which should match or does match the funding that was attributed to the fund of just over $2 million. So from my orientation, that supports the concept of redesignating $1 million of that fund to a designated board initiative designated fund.
Yeah, can you help me with that? Like, how does that work? I'm just trying to
The
understand
board?
mechanics.
So,
Well, I mean, right now, the designated cash for asset replacement is 2.9.
Yep.
And 2026 is 3.
Yep.
Right? So when we say we're redesignating,
so take $1 million from that, so
take
that,
$1 million from the 3?
Yep.
Okay,
And
so
that-
that gets that back down to 2.
which matches the accumulated
reasonable.
depreciation
Okay,
or
and
the,
then- So is that cash? So where's that? There's actually cash sitting somewhere, right? So
it
that,
would, cash is all in our operating fund,
no, I get that.
right?
Right, it's sitting. So
I've
how's it-
allocated that amount. It actually is more than that total
It's this-
amount into the designated cash resources that are with Morgan Stanley. So it would still sit in Morgan Stanley.
No, I
It's-
understand that.
okay.
It's just.
We're creating a new
just
bucket.
That's what I'm asking.
We're creating
So
a
you'd
new
have
bucket.
another
There'll be a
line
new
here
bucket here.
that
That's what
says
I'm asking.
designated.
Okay,
board
and is there any,
initiatives.
that can be for anything?
No. So let me take a little discussion on this. So I think the idea, which we touched on at our last meeting, was that it would be appropriate for the board to identify certain probable costs in the future that are not in the budget currently. So we have to go through an annual budget process. The board may identify certain expenditures that are not clear enough, either in terms of amount or timing, to include in the budget. A good example would be if there are additional costs associated with our front gate access operations, or if there are startup costs associated with an association ARB, or unidentified amenity increases that we think might be relevant. The idea is to take, I'll call it excess, small e, excess in what is currently the accumulated reserve here, designated reserve, and create a board fund for named, identified initiatives that are not in the budget. And so the members would see, okay, this is a probable or possible use. This is a possible use. To identify what those are and move $1 million into that new bucket of items that are not specifically in the budget, but are, sensible future cash requirements.
So if.
Hey, Paul, can I ask
If in
sorry,
2026,
Paul.
that number goes from $1 million to $500,000 because $500,000 is spent, is the expectation that it would get refreshed to $1 million in the following year?
That would have to be a budget decision. That would
So
have to be
I had a
Certainly no.
I had a similar
Not under the
question.
realm.
Like, I had a similar question in terms of how is the amount decided for the initiative?
Are you talking about once we've allocated the million, how is
Well,
that?
yeah, like how is the million kind of decided? And I'm not even like questioning whether it should be $1 million or 2 million. I'm just curious is it the board saying, well, the initiative this year, we need 5 million? Like, and I know that finance committee is limited in what we can do. I'm just curious, like mechanically, that's not within the realm of the finance committee to suggest.
Fran, this is Shannon. I think your question is going to why we picked $1 million. The finance committee
Yes.
felt that that replacement fund was overfunded. And so that comment came up in the last couple meetings. Dale had looked at that asset replacement fund. He was suggesting $1 million. At the last meeting, Paul asked him to do some additional work and related to our assets within that asset replacement fund. That's where he came up with, we have 2 million in assets, and it supports him moving $1 million out of that, what the finance committee considered overfunded.
Okay, I see. Yeah, I'm just curious
That
about the
makes sense?
mechanics, like going forward. It was more just like who kind of makes the decision,
Right,
what the
and so the
board initiative fund is.
Right, the finances committee's recommendation was asset replacement is overfunded. So we need to get it back to the right level. They agreed with moving $1 million to a board designated fund. Please understand, I don't have access to that money unless the board votes on it. I can't use it as a slush fund or anything like that. So it has to be board-led initiatives.
And the million was justified because Dale presented a schedule that looked at spend over the last 5 years.
Yes.
And when we looked at the spend, there's no way we needed 3 million. We need 2. That's the basis.
Yep, it was.
Okay, I got it.
excess.
Thank you. Again, I apologize. I missed the last 2 meetings, so
Yep.
I probably, if I hadn't missed it, I'm sure the answer I wouldn't have asked. But thank you very much.
You're good. So my orientation is, at this moment, it's a one-time consideration for the board. Now, what they do in the future with regard to something similar, that's yet to be seen, but this is a one-time activity that the board's going to decide on.
And it will have
next
to,
week.
it will have to pass muster for the auditors.
Sure.
Basically, as well.
I'm sorry, what'd you say?
It will have to pass muster for the auditors. Once we present the annual tax return with the balance sheet, we've got to justify the reserve.
No.
I don't-
No,
I
Our
don't think
reserve
so.
is our reserve. I
Yeah,
don't think,
yeah.
we're not reporting.
it's a designation of cash, isn't it?
It is or it isn't. It's not going to make any difference relative to
No,
what we're
but it needs to
deciding
be of
this morning.
substance, in
Okay.
my view,
Okay.
justifiable.
Yep.
I think
Fine.
it's still on board-led initiatives that benefit the community association as a
Sure.
whole. So I think it's still going to our primary mission.
Yep.
One thing I will say is that, obviously, we want to be very, diligent about this and look at the, financial control manual. And we may need to make amendments to the financial control manual to recognize this new board initiative designated fund, to make sure that, from a governance point of view, there's no ambiguity, there's formal board agreement, there's clarity, there's a transparency to the community. So we wanted, I think this is a good idea. It's sensible, it's logical, but it needs to be appropriately documented.
So with that being said, then on this last page, it's more of a summation. We need to finalize the recommendation that it considers the budget philosophies that we've discussed in prior meetings, which was an annual balanced budget, rates charged to constituents increase consistently year over year with inflation, and target a year-end unrestricted cash balance of $500,000 to $1 million. And I think we've done that. And at this point, staff is recommending the board approve and the finance committee support the 2026 draft operating budget as it exists on page 3, with the addition of a 3.3% assessment rate increase and a redesignation of $1 million out of asset replacement dollars to the new designation for board initiatives, as we discussed, with the understanding that the 2026 budget to be approved includes flat commercial. So what I'm doing with this paragraph is just acknowledging what the key elements that are included in the, and what have been discussed in the budget process. To be approved includes flat commercial assessment rates, amenities rates as detailed, the elimination of preserve and ocean park segment specific activities, the capital purchases as detailed, the independent internal controls review, and the allocating of the $1 million to the designation. And then the reserve budget, we're recommending that 2026 reserve budget draft be approved or recommended as well.
One comment, now that we've added 200,000 to the employee benefits line, our benefits are now approaching in excess of 20% of our payroll cost. I would just reiterate that I would like to see that benchmarked, because it is, to my mind, 22% or whatever it is now. Employee benefits as a percentage of payroll cost is quite high, to my mind, just based on history, knowledge.
Sarah, is that true? Is it quite high? Yeah, okay.
We should look at it. It's 200,000. We've got up 10% in our employee benefits line.
So whenever, in my experience, whenever I've done a kind of a flat estimate of employee benefits as it relates to payroll, I've always allotted 20% as
Yeah, we're now
benchmark.
23%.
Oh, so
I'm just making the point, that's all.
okay.
I'm just not accusing anyone of being
Yeah,
lax.
no, you're fine.
And Dale, that does not include the employer taxes, right? That does not show up in the benefit cost.
Taxes are in the wages portion of the.
Okay, all right. I mean, that's a couple points higher than I run, but I'm a bigger company, so I do agree that it's definitely been creeping up. So
Hey
Okay.
Dale, is there any like I know you're mindful of reinvesting our using our cash and investing it, even if it's in, some T-bill or some type of strategy. Is there anything to discuss there in terms of the buffer of how much we're leaving in cash at various points, versus, putting that into some type of investment?
So.
Or are you
my strat-
comfortable kind of with the cash balance as they are?
I am. I mentioned it earlier that the balances as of Q3 were a little higher than what I typically like, but
Yeah.
we just had toward the end of September, we had maturities that just came about, and the next day I transferred, so as of October 1st or 2nd, a bunch of money went into another investment, right?
Okay.
So just so you know, my strategy is to keep about $100,000 to $150,000 in checking. And then the rest of it, for the most part, is in a money market fund that over the last year or so has earned between 4 or 5%.
Okay, great. Thanks. I was like more curious about, where we're comfortable with the buffer, but it sounds like we're pretty tight. So thanks.
I analyze that for the most part on a weekly basis to make sure that I've got enough to pay the next check run and payroll, and then I just roll it forward.
Yep, thanks.
So this then, unless there's more comments, will be the basis for moving forward to the November 3rd workshop with the board, which is next Monday.
So I would like to propose that the Finance Committee endorse Dale's recommendation. Any discussion? Any additional discussion? All in favor?
Aye.
Any opposed? Thank you, Dale.
I think that might be it.
Will you share with us the final version of the budget that you present to the board on November 3rd, or
So
not until the public meeting on the 10th?
I intend to present exactly this to the board on the 3rd. And then I anticipate them providing guidance but we need to give them materials. Let's see, Monday. I
You
might
have
be
to
able
give
to give
them,
them a final budget. Either way, it'll either be in this form for their approval on the 10th. But if I can, between the workshop and when I have to provide them materials for November 10th, if I can push through that 3.3% and all that, then yes, I will update you as well.
right,
I
board,
guess that was a long way of saying yes.
You were thinking it out loud. I got it.
Yes.
board materials are due tomorrow for the November 3rd session, so Dale doesn't have a lot of time to make change. But on the November 3rd, he has until, that's a Monday, he has till Wednesday to provide board materials for the 10th. And the board has been receiving your materials as we've moved through this process.
I think that's it on the agenda. Yeah, unless there's member comments.
Member comments. Ellen, we have hands raised.
We do. Our first hand guest is Todd Bonet. Todd, you are muted on our end.
Okay. Hey, Dale, just a couple of questions. You mentioned there were 3 individuals, really the outliers. I assume they were individuals with chronic conditions, not acute conditions like a preemie baby.
I guess that's correct, yeah.
Okay. And when you say that we're moving to fully insured, are they taking all lives without qualification?
Yeah.
Okay. Okay. Thanks. Second question.
Hang on. sorry. So are all of our employees going to be covered under this new single provider, or only those employees who choose to be covered under the plan?
That's, yeah, everybody, there's other people that, for example, we have 86 out of 110 people that
Okay,
participate in the program.
I just wanted to make that
So
distinction.
open enrollment will be December, and people have the opportunity
To sign up or
in.
not?
Yeah.
Okay.
And I think Todd's question was going to, our fully insured plan wasn't going to disqualify a pre-existing condition, which they are not.
Yeah, and Shannon, I appreciate the clarification, because I actually went through this in the past, and I can't recall the specifics, but there was something odd that happened when we went from fully insured, or went from self-insured to fully insured. Dale, when we say we're saving 300,000, that's 300,000 compared to what? Is that compared to projected calendar 25, or was that 300,000 compared to a prior estimate for 26?
I think it's compared to the, I think it's compared to the estimate or projection for costs for 2026. So
Okay.
it's based on our budget. So the original budget for 2026 was X. This moving to fully insured will provide X minus 300.
Okay, so and again, you just might want to clarify, because I think you could argue that maybe the prior budget estimate for 26 was wrong. It's not, you're not actually saving. I mean, what would the savings be
So-
compared to calendar 25?
Right, so our 2026 budget was estimated by USI based on our current program. And that's what we set the 2026 budget based on. But then
Okay.
we continued with this working group in order to find alternate solutions. So we were able to lower what was listed in the 2026 budget.
So what we have in the 2026 budget is what we still expect for if we just renewed with self-insured program.
Okay, and what would the comp be if you were to look at the assumption for 26 compared to the projected or forecast of 25? If you don't have it, that's fine. It's, you know, it was a little bit confusing to me what we were comparing it to. And Dale, the last question I have, and I know I've brought this up in the past, when we were projecting year-end cash at the end of calendar 26, of call it 600, that still strikes me as low. And I apologize. I know I asked this probably in the past, but is our payroll twice a month, or is it twice weekly?
It's
I wish it was
26 pay periods in the year.
Right, every
Okay,
2
good.
weeks.
Okay, so, and the reason I'm asking is just, you know, it strikes me as a bit low when you probably don't start getting collections on what would then be 27 assessments, probably until later in the month. And it's just something I think the committee should probably look at, because I would assume you're probably down to, by the time the collections start coming in and you've already funded one payroll, you're probably down to, 200 or so.
Well, okay, so with the 3.3% increase, we're going to go over $1 million in unrestricted cash. So
Okay. So with the 3.3, you go to $1 million at the end of calendar 26.
correct.
Okay, good. Okay, thank you.
You're welcome.
No other questions?
Okay. Thank you, Dale. Any other questions or comments from the committee members or members in the room? Hearing none. I move for adjournment. Do we have a second?
Second.
All in favor?
Thanks, everyone.
Thank you.
Thanks,
Bye.
Dale.
Have a great day. Thank you. Bye.
Thank you.